Good morning, everyone, and welcome to today's webinar, Bank Statement Loans for Today's Self-Employed Borrowers. During the webinar, as questions arise, as I'm sure they will, please go ahead and use the Questions tab, little function, and at the end, we're going to have a Q&A and we're going to answer your questions. Today's speakers are James Gelso and Joe Leiden. Jamie, take it away.
Thank you, Rose, and I'd like to thank you all for joining. Go to the next slide, Rose. Thank you. Today's agenda real quick. We're going to tell you a little bit about LendSure Mortgage and what we do. We'll touch on the state of today's lending environment. Clearly, things have changed a bit over the last 90 to 120. We will, of course, talk about our bank statement loan program, a little bit about some other things we do that might help you. And of course, as Rose said, we'd be glad to try to answer any of your questions once we're done. Just a quick tad about us. LendSure Mortgage Corp. We were founded in 2015. We're headquartered in San Diego, California. We've got a couple of regional operations center in both Rhode Island and Georgia that support our eastern folks. We have securitized loans annually since 2017. They've all performed very well. We have a highly experienced team of non-QM veterans who not only have decades of non-QM experience, but decades of experience working together. And we lend in 41 states, and that's always growing. A little bit about what we do in general. We focus on making good loans with a solid benefit and loans that perform. We really serve the A paper credit borrower that you deal with on a very regular basis, the lion's share of your business probably. Most of the folks we deal with are A paper credit quality that just live on the fringes or the edges of a Fannie or Freddie type product. Things like bank statement programs, asset depletion, and the investor cash flow product known as DSCR. Generally, our loans are very high quality, as we touched on. Average FICO is a bit above 700, and LTV is just under 70. A few things we do not do. We don't do any Fannie, Freddie, or government business. We certainly don't do any foreclosure bailouts, and at this time, we do not offer any second lien positions. Just touch real quick on today's economy and how it may affect the lending environment. I'm sure you've all felt this. On any given week or month, the stock market is up 1,000 points and down 1,000 points. In a matter of 60 days or so, we saw unemployment soar to levels, quite frankly, not seen since almost 100 years ago or so, although now it's shown some signs of recovery, which is promising. Forbearance requests obviously have jumped considerably from March to the current date. Many businesses have been impacted, as we all know, particularly retail. And there's still a bit of an uncertain future. Will the economy come roaring back? And do we have a cure for this virus, or do we have a second wave? And how is the pandemic really affecting lending? Again, I'm sure all of you have lived through some of this, but many programs that existed 90 days ago are no longer around. Many of the conforming and government and jumbo folks have tightened products. HELOCs in general have pretty much dried up. Lending can still be done to good borrowers, although lenders may have to work a little harder to quantify that. And as you all well know, most lenders have made some kind of pandemic-related adjustments to their process. That varies, whether it be last-minute verbal verifications or different questionnaires or different attestations. So, thank you. We'll now touch specifically on the bank statement program, which is for self-employed borrowers. One thing about us at LendSure, what we really try to do is an upfront evaluation of the income piece. The last thing we want to do is get your borrower down the road and then disappoint them. Bank statements are, very particular. You have to look at a lot of different aspects of them. A few nice things about us: we do not require a P&L statement. We will go up to ADLTV. The borrower does not have to be 100% owner of the business, which is a nice caveat. Obviously, some people have partnerships or have family businesses. We do ask that they own at least 25% of the business. And we accept both personal and business bank statements. We use a variable expense factor, which is pretty unique to the industry, and it helps with a lot of loans. The reality is most businesses are different. A restaurant will have a very distinctly different expense factor than, say, a stay-at-home consultant or engineer. And so we'll dig in a little bit. We'll ask the borrower some specific questions about their business. We've got a very specific and simple one-page form, self-employment questionnaire. We'll ask some things like, what's your overhead in terms of rent and payroll? And then we'll apply an expense factor that we feel makes sense for that industry. How do we stack up against some of our competitors? We feel we do pretty well against our friends. We do not require a third-party prepared P&L or some kind of proof of expenses to support a ratio. We do not have a minimum expense factor. Really, I've seen us go below 10% based on the industry. We will go to 80%, obviously. Many people will not at this time. We do not, again, need the borrower to own 100% of the entity of the statements we're using. Prior to full underwrite, once again, we would love to see the statements and help you quantify the deal to make sure, most importantly, we're providing good customer service for you so you can in turn provide it to your borrower. And we will allow for some NSF and overdrafts. We'll look at the story. Some businesses are seasonal. Some sole proprietors might have trouble during the week getting to the bank. So we will look at those case by case. I'll now turn it over to Joe Lydon, who will discuss some specific scenarios that we've closed and some of the particulars behind them.
Thanks, Jamie. I'm just going to talk through 3 or 4 different examples of where we think we're different than many of our competitors. Jamie mentioned earlier that we use a variable expense factor, which I'll speak a little bit about, but I think you all would agree that most businesses are very different from one to the next, and he gave you an example of that. But there's several other things that we do that we think are different as well. So this first scenario is a place where we will allow you to use multiple accounts, all business bank statements. Many of our competitors won't allow this, but we think it makes sense. And here's just an example to kind of put that logic on display. With salon owner with 6 different locations. He's got a 700 FICO, 840 loan amount, rate term refi, investment property at 65 LTV. Well, the reason we're using multiple accounts is because the borrower has an account for each one of his locations. And he does that for obvious reasons. He wants to know the profitability for each location. So he finds it easy to just have a bank account set up for that location, which he does. So he runs all of his business for that location out of one bank statement. So all of the revenues come in and out of it, and all of his withdrawals represent the expenses associated with that business. So we can't tell a borrower how he must run his banking associated with his business. In this case, we think that makes sense. We've seen this very often, and so we allow for it. Next slide. And the next one is using multiple accounts and business, and some of the accounts are business and some are personal. Now this is a little unique. No one allows for this as well. But again, we've done enough of these things to understand that there are occasions when it makes sense. And I'm just going to give you an example of when that one of those occasions. So borrower is general contractor, but he also owns 15 single families, all generating rental income. His FICO is 764 rather. It's a 750 purchase money transaction with a 75 LTV. So the borrower's business bank statements he uses for his contracting business, which would make sense. Okay, so we can clearly underwrite the business bank statements, and it's likely that if he's a general contractor with subcontractors, and we can see that usually by looking at the withdrawals that he's paying out monies to subcontractors. Revenues are usually pretty high, and he's paying a lot of it out to subs. So we'll use probably a 75% expense factor on his business bank statement. But then we say, well, Mr. Borrower, where are your rents from your single families? So we have to, we don't get to look at his Schedule E, look at his tax returns, because we're doing a bank statement loan. The borrower responds and he said, well, those rents come into my personal account, and And by the way, I have all of them set up on ACH, and so they all have their own column. I can track the rents each month from his tenants. And so he sends me his personal bank statements, and I can see that, put it on display, and I said, well, okay, I can see that that's not double counting income coming in from the business bank statements. So no, that's an example of we ask for a good schedule of REO. We then go out and look at all of the properties that he's got. We go online, take a look at where those properties are, and we just solve for the Zillow rents to see if they are close to what he says he gets in rent, and then we match that. And, you know, we don't have to be spot on top of it, but we look at what we see in the bank statements. We make a loan using both personal bank statements and business bank statements. So the point is, we use logic. You know, there are occasions when we are able to do an analysis that gets us comfortable in such a way where we're not double counting income. Next slide. This next one is using the variable expense ratio. I really don't need to go into this too much because Jamie already hit it pretty much, but kind of getting to the bottom right portion of this, a graphic designer working out of his house has very, very little expenses. In fact, I would argue that he's sitting in front of a computer all day long and has almost zero expenses, but we'll use 10%. But on the other hand, a restaurant and many other businesses, we're going to use higher expense ratios. So we don't think it makes sense to use one size fits all expense ratio across the spectrum. There are plenty of businesses that have very high expense ratios, 75, 80, 85. So our expense ratios go anywhere from 10 to 98, and with plenty of them under 50. So we think it makes sense. We think we are actually leaning forward in those deals where we know that our competitors won't go less than 50. And we look at it and we say, this loan makes all the sense in the world. Let's do it. So we're getting good loans. But then on the other hand, we think that when competitors use a 50% expense factor on a restaurant or some business that clearly has high expense ratios, well, it wouldn't make sense to do the loan. And we say, well, if our competitor is doing it, they're probably going to have some performance problems on that kind of a loan. And we avoid those loans. So we're not able to do every one of your loans. We don't suggest that we can. We try to do what Jamie suggested earlier, and that is we make loans that make sense. We are always endeavoring to make loans that perform. Next slide. And finally, here's another area where we're probably a little different than most of our competitors. Most of our competitors require that you're the 100% ownership of the business. We do not. We will allow for additional partners. We're going to ask some questions. In this case, the borrower is a dentist, 20 years in LA. There's 6 offices and 3 partners. Purchase money loan, $2 million, 40% cash down, and 810 FICO. So you can see that the borrower looks pretty good, but he's bank statements. And so now, but he's a bank statement deal, and we're looking at him only owning a portion of the business. Well, in order for us to consider him for a bank statement loan, he's got to own more than 25%. So very often we're going to ask for the partnership agreement or the LLC docs or whatever operating agreement that they have defined between them. We need that to discern what percentage of the revenues / profits go where. And those agreements are all over the place. Sometimes it's as simple as, okay, you have all of the revenues and profits out of this location. Okay, that's easy to do. You can go out and get those bank statements that support that location. Sometimes it's not quite that simple. Sometimes they aggregate all of the revenues and the profits, and you have to then just divide by, you analyze the bank statements, you come to an expense ratio, multiply the expense ratio against the bank statements, and then you split based on the ownership profit sharing, which is defined in the rental agreement or the operating agreement. And then you come up with an income number. So then you move forward. So these are just 3 or 4 areas where we think we're significantly different than our competitors. I think this, combined with the fact that we'll analyze your bank statements up front so that you folks have an income number that you're working with kind of on day one. That's usually what makes most loan officers nervous. You know, I got all these bank statements. How can I figure out whether they got the income? We want you to know the income up front so that you don't have to pull together a full package and then submit it and then wait for 2 weeks to get an approval, and then only to find out that the bank statements aren't going to be adequate. We like to get that mystery out of the way up front. Without further ado, I'll pass the ball back to Jamie and let him come into the end zone.
Thanks, Joe. We'll touch a little bit more on some of the opportunities we can help you with at LendSure, and then we'll wrap it up with some Q&A. We do a fair amount of cash out loans. I'm sure you know some of that activity has been curtailed in the secondary market. We have allowed as much as $1 million cash out based on the particulars of the loan. We have a very extensive non-warrantable condo program, including some of the condos you might see above places like a Mandarin Hotel or Four Seasons Hotel. In addition, we do actual condo-tels, very common in some markets, particularly Florida. We'll accept larger acreage properties, assuming hopefully you've got some good comps or something at least similar. 2 to 4 unit properties as well. We have a pretty unique way on investment properties and multis of using the negative cash flow to our advantage as opposed to traditional Fannie methods. Second homes, of course. We do jumbo loans. Again, some of the secondary market constraints lately have affected the jumbo loan market. We're still very active in that. We go up to $3 million. We, of course, do the DSCR product or investor cash flow loans. And you just heard a fair bit about our bank statement loans. Next slide. And we offer asset depletion, which can be used either as a sole source of income or as a supplemental piece. It's not uncommon for us to see a loan where we have income from bank statements and also asset depletion to make the debt ratio work. We have a pretty strong interest-only product, including a 40-year term. So basically, it's a first 10 years interest-only, then it automatically converts to a 30-year fixed. Real strong product, one of the most progressive out there. We do offer loans to non-permanent resident aliens. We offer some construction takeout products. We will treat lease options and land contracts as refis. And of course, we'll do some properties that are held in LLCs with the standard restrictions. Very unique to LendSure, we can finance up to 2% LTV, any lender or broker costs into the loan at LTVs of 75 or less. So, for instance, if you had a 75 LTV loan with us and you were trying to get 2% BPC, most cases, obviously, the borrower would have to bring those funds to the table, which is not always easy. With us, we can finance that BPC into the loan. It would go above 75, but you would not be priced above 75 nor held to the underwriting guidelines above 75. It's what we call a stack. It's very unique to us, and it certainly can help your cash to close situation for your borrowers. Next slide. And lastly, we've got a pretty robust private label resource kit. Rose, who's on the phone with us, handles that stuff. Many of our partners like it. If you're trying to get them the new realtor, perhaps you can show them that you can do some condo-tels, for example, or some asset depletion. So if you contact your account executive, we'd be glad to help set this up for you, and hopefully we can grow some business together. With that, I would thank you for your time, and we thank you for your business, and we'll open up to some questions and answers.
Thank you, Jamie. And if you haven't already submitted your questions, please go ahead and submit your questions using the little questions tab. Now, I'm getting a lot of questions on whether they're going to get a copy of the slide deck, whether they're going to be getting a copy of the recording. Yes, look for the copy of the recording and a copy of the slide deck, along with a link to the private label resources in a thank you email that you should be getting within about an hour. So with that, does this rental income go against the mortgage payments as a total income?
I think if you're asking about the rental wash, perhaps.
Ask that question again, Rose.
I'm sorry, I just deleted it, but it said that how do you handle rental income? I think it was in relation to the loan scenario that we did earlier.
Yeah, okay, so put simply, again, we're alone in the way we do this, but here's an example of how we're able to do Fannie Mae loans that true to a Fannie Mae customer, but we calculate the income differently. So just think about it this way. whether you're doing it Schedule E method, meaning you're dealing with properties that are already owned by the borrower, you take the income from the properties, you add back the depreciation, and you'd use that number, and if it were negative, you'd draw that negative would come over, and it would be a debt for the DTI calculation. With us, if we did that and it were a negative, we would offset other income. Same thing, net rental method. If you're buying a new rental property, you'd take the rents off of the 1007 or the Form 216 if it's a 2 to 4, and you'd take that times 75, get to a net rental income, and then you'd subtract the PITI, and you'd either get to a positive or a negative income. Again, if it's a negative income, Fannie, Freddie, the A-paper world is going to take that negative, and it would become a debt in doing the DTI calc. With us, we don't do that. We draw it over to the income and offset income. Usually that can have a very significant effect on the DTI in your favor in getting the loan closed.
Do you do cash out in Texas?
Yes.
Do you have an ITIN program?
No.
Okay. What's the difference between the 2 to 4 program and investor 2 to 4? And is the DCR negative maximum?
Not sure I understand that question. Let me try, and then Jamie can follow up with me. You know, there's an owner I can be an owner and want to buy, or I'm sorry, I could be an individual who's a renter and want to buy a 2 to 4 unit and live in one and then rent out the others. In that case, it would be an owner-occ 2 to 4. And I could do the reverse. I can own my own home and I find a 2 to 4 unit down the street that I like and think would make sense for an investment portfolio, and I might buy that, and then it would be, in that case, a non-owner investment property for me. With respect to the DSCR, clearly the owner-occupied transaction I just addressed would not be available on a DSCR basis. The DSCR is it's an acronym for Debt Service Coverage Ratio, and that program is for investment properties only, as it doesn't do a traditional DTI calc. It is focused simply on the debt service of the property itself. And with us, that number needs to be greater than 1. Frankly, our guidelines say 1.25. We make exceptions down to 1 if we think other elements in the transaction make sense.
While I realize there are variables involved, when looking at a typical turn times, what should we be quoting to realtor partners and borrowers?
That's a good question. I think the service that we offer is a little unique. We like to work with you on a concentrated basis upfront. So the answer really is dependent upon you. If you deliver to us a fairly complete package, in fact, if you do deliver a complete package, top to bottom, with an appraisal included, we can and do often get loans closed inside of 8 days. That is, if we in fact are getting a full and complete package. So that's on you. Now, back to our process. We have a front-end pre-qual team. So a lot of times the broker starts out with a scenario. They give us a few bits of information and they say, okay, enough of that. Okay. So that's a salesperson for you. It's calling me 17 times inside of 10 seconds. Really, most brokers start out with bits of information and they call us up and say, can you do this? Can you do this trust? Can you do this property? They try to offer up the elephant in the room. What's the issue? We try to deal with the issue up front. And then if we give them a green light and say, yeah, that's something that we can do, then we like to work with you in building a file. No, it doesn't have to be that way. You can send us a 1003 in the credit and a full pack, boom. And if you send us a full pack, we can get that done in a couple of weeks. But the question is it a full pack? The last thing that we really want is to change things at the 11th hour. We like to get things up. We like to get things understood and upfront. So we want to have that back and forth dialogue. So it may be 2 or 3 days whereby we're working with one another. You're seeing that my account executive really does have his shit together. He knows his way around the topic. He's asking good questions. You're giving him the answers. Sometimes you have to go to the borrower to get the answers. But in that 2 or 3 day period, we've essentially underwritten the loan together. And by the way, there's an underwriter in the background that's kind of coaching the AE and working with the pre-qual team. And in those cases where we do it that way, it may take us a couple, 3 days to build it and say, okay, we've got everything we need. Boom. Then you formally submit it, and we can get it closed in 7 to 10 days from that point. But it's really a function of the quality of the package that you sent us. What are we dealing with here? If you're the kind of broker that wants to keep things a secret to us to see how good of an underwriter we are, and you're hiding stuff, and we're going to fight it downstream, okay, we can play that game. We have brokers that are like that. It's unpleasant. We don't think it makes sense from a customer service point of view. It's not our preference, but we do have brokers that operate that way. We prefer to deal with the first thing that I described.
Okay. Here's a related question. When submitting bank statements upfront, how long should we expect to wait until we know the income being used?
Ask that again, please.
When submitting bank statements upfront, how long should we expect to wait until we know the income being used?
That's a good question. Here's specifically how that works. When we get that, if you send us 24 months bank statements, and not 22 and not 18 and not 13, 24, we're going to assign that to someone and they're going to begin working on it. But one of the first things that we're going to have to do is send the borrower through you a self-employed questionnaire that basically asks the borrower, what kind of business are you in? Give us a sense for your business. How many employees do you have? What does your labor look like on a monthly basis? Do you have a physical location outside the house? Do you have cost of goods sold? Do you have any other extraordinary expenses? And we need that information up front, because when we do the analysis, we're going to have that in our mind when we're looking at the bank statements themselves. In terms of spreading them and getting that detail in front of us, usually it takes a day. Sometimes it can be done in several hours, but usually a day. Sometimes it takes 2 days because it's an iterative process. That process is a little bit elongated now given the COVID issue. Now we're going to ask additional questions around COVID. We're going to be asking questions, how did COVID affect your business? And where are you now relative to where you were 4 months ago? And so clearly we need to know that you have the income, but we're going to dig into it. Just because your income may be down doesn't mean we're not going to do the loan. It means we're going to evaluate it and see if it fits. We've done plenty of bank statement loans since post-COVID, since we've been back in over the last 2-3 weeks, and we've done plenty of analyses where it's worked. But we do ask more questions because we got to get to the bottom of what's things look like for you right now. I can tell you right now that the restaurant guy coming into us right now, and we're going to be asking questions like, well, what percentage of the business is back? What we have found though, however, and this you might find interesting, is some folks have really reinvented their businesses in this last 90-day period. We have one guy whereby he was operating a kiosk in a mall, and he was basically he was kind of an electronics guy. He fixes gadgets like cell phones and iPads and things like that. Well, the city shut down the mall, so it shut down his business. So he quickly turned it around into I offer mobile services and online services, whereby you can deliver your gadget to me and I'll fix it. And literally, he put on display for us whereby he entirely changed his model, and he was making as much doing that business as he was when he was doing the business outside the mall. So he says, we had that dialogue, and we were talking directly with the borrower, and he said, so for me, I feel like I've just gained a huge advantage because now I'm going to do both. And, so while I don't think my revenues may double, I'm going to have to hire some people to handle the increased business because I won't be able to do it all myself. So suffice it to say, call it 4 hours to 2 days or so, really has a lot to do with the quality of information that you're delivering to us, and then that back and forth with the borrower. If you fight us on that, it'll take longer. If you work with us on that, we'll work together and get it done.
Joe, I've got several questions on where people can find our rates.
We don't publish rates on rate sheets. I would say contact our account executive, talk about a loan, and we'll structure a loan for you with the pricing.
Okay. Interest only for 40 years? Did I hear that right?
Yes, unless you have bad ears. Yes, it's designed as a 10-year IO, and then it converts to a fixed for the balance of the 30 years. So that product is a terrific product for all investors, because most investors are tuned into cash flow. So when you calculate what the interest-only payment is going to be, you'll see that's a big winner when compared to a fully amortized 30-year loan, even if it's a 5-1 or a 7-1 ARM. The other thing to note that is on that product, because if it is an investor, and not all of them have to be investor, but if it is an investor, you can qualify using the start rate. But they are available. The same 10/40 is available for owner-occ as well.
Okay. What's the minimum credit score for foreign nationals?
Let's see here if I have the rate sheets up. If I do, I can give this foreign national minimum FICO. What did you say? The minimum credit score? That was a trick question, right? Is that what was that? The minimum credit?
Yes.
Yeah, that was
minimum credit score for foreign national.
Yeah, that was a trick question because foreign nationals don't have FICO scores, so that's the challenge. We don't get FICO scores on foreign national borrowers. Usually, we're looking for some sort of alternative doc credit from that country of origin. So, in the case of Chinese, we have some Chinese employees who do a fair amount of Chinese foreign nationals. We know that China does have a credit bureau that looks a lot like ours. We can interpret them because we have the employees, so we do interpret them. And so in some cases, you are able to get foreign credit bureaus that look a lot like ours. In some cases, you have to fall back to what I call alternative doc, and alternative doc is getting 2 or 3 reference letters from local financial institutions in the country of origin.
Okay. When a borrower has a W-2 and also 1099, can that borrower do bank statements?
Absolutely. That's a hybrid. We see those kinds of loans all the time, whereby husband or spouse, borrower number 1 is full doc and borrower number 2 is not full doc, whether that be 1099 or whether it be just guy runs a restaurant or he's a software engineer or whatever. So that's not unusual at all. We do those hybrids all the time.
Okay.
And what we do is we would full doc the wage earner income, and we'd use that gross income for borrower number 1, and borrower number 2, we do the same thing that I was describing earlier when I say we do the full bank statement analysis.
What's the LTV for foreign national loans, and what type of proof of income are you asking for?
Okay, let me pull that up again. I don't want to misspeak. Foreign national, the max LTV is 65% today. And what was the second question, Rose? LTV?
It was, how do we handle proof of income?
Okay, income's another question. It's here again, the way our guidelines are written, I'm going to get outside the box here a little bit, but the way our guidelines are written, it says that you've got to get a CPA letter from a country of origin, and if they're working for an employer in the country of origin, then you can send us the documentation, just like whatever documentation that they would have similar to a W-2 and a pay stub. Mostly it's a mostly it's a CPA letter, and so which is, it's kind of a wink wink kind of program, and that's what makes foreign nationals more risky loans. However, I would tell you that I look at loans a little differently than some others. I'm not a guideline guy. Hate guidelines. I like to think through the risk. And when I'm thinking through the risk of a loan, I'm thinking about income, equity, credit, and assets. So when we're talking about foreign national, generally speaking, when you look at the guidelines that exist out there, you find out that the income and the credit piece of those transactions are a little flimsy. And then you're left with the assets and the LTV. Usually you'll see lower LTVs and they do have assets, and you're basically making a loan based on the asset. And because you're blind on the other two, I mean, you're doing the wink wink thing. However, there are plenty of loans with our Chinese national loans, and then others as well. I think there's plenty of times when you can go to an extra level and actually get comfortable with income from the country of origin. I'll give you an example. French foreign national guy lives in Paris, needs 2.4 million, wants to buy a $2.4 million house in La Jolla, wants to put 25% down, has about $700,000 in assets over and above the assets needed for the down payment and reserves. So we like the assets, we feel good about it. We can see that the assets are in a French banks, I should say. So we feel good about the assets. We feel good about the LTV, 75%. Guy doesn't have US credit, but the guy's an executive in France. And I know that he has credit cards to operate. And I know he has a mortgage in France because he's got a flat in Paris. So I asked for, can you give me the mortgage statement on the flat in Paris? And can you give me the credit card statements so that we can send letters to those? And we could. So now all of a sudden credit, which I was concerned with, I'm not concerned with. I can see he's got good credit just like someone in the US would. Then the question is income. Well, this guy in particular, this is a live loan that we did. This guy was working for a French company for the last 7 years, and they were opening up a division in La Jolla, and he was going to run the division. And so they gave us an employment letter that said he's going to make $240,000 a year plus another $140,000 in bonus. So we were going to use a 380 number. And so, the question is are you going to take that letter? Well, I'll tell you what I did. I went back to them and said, can you tell us what he made in 2017 and 2018 in Paris? And the guy was used to making $350,000 a year. So I looked at it and I said, well, okay, he's been working for this company for 6-7 years. They're moving him to the US. Why wouldn't I believe this? Because they paid him $350,000 the previous 2 years. So yes, I am okay with that letter, that letter that described his employment. So in that case, we took those two flimsy legs of the stool, my proverbial four-legged stool, those two flimsy legs, credit and income, actually, when I was done with it, were pretty tight. And I looked at it and I said, this is as good as most loans that I see in the US. So let's do it. And we did it. So there's always ways, like when a broker works with us and allows us to dig and ask some questions, if we can get our arms around it and make it stronger, we'll be more aggressive and do it. But we do allow for the flimsy, the letters of explanation for both income and credit. And in those cases, we don't make many exceptions. So in those cases, we wouldn't have done a $1.8 million loan at 75% because our foreign national doesn't allow for greater than $1 million loans.
Okay. I've got several people saying that they have loans that they want to submit, scenarios that they want us to take a look at, and asking about who their account executive is. When you get the thank you email in about an hour, go ahead and respond to that. That's going to go to me. I will connect you with your account executive, or I will forward your loan scenario to a regional manager. So go ahead and ask any questions or send me information. Respond to that, and I'll take care of that for you. And where do we see non-QM rates going?
Good question. with all of the turmoil that took place in the, first off, the COVID affected the markets, our markets and the jumbo A market in a big way, because the government didn't come in and save the day for either ours, the QM space, the non-QM space, or the jumbo A market. So all of you brokers saw that those markets, those products vanished. And the reason for that is there's two ways, and there are two components to valuing a securitization, or they've got to understand the underlying credit risk, and they have to have money costs. Well, the money costs are usually the 10-year. That's easy to figure out. And all of you know that that's down, maybe up a little bit recently, but it's been down, and it's down significantly for the year. The other piece, though, credit default swaps, that's not easy to discern. And with 20% of the American public laid off, everybody's concerned with both the non-QM space and the jumbo A. But that concern has been waning, okay? So we went through, call it the period in time of which, America was shut down, and now it's begun to open up. Okay, so all of the legacy loans that were on non-QM lenders' balance sheets, they have now been either sold off or securitized. Our partner, Ellington Financial, did a securitization last Friday, about $300 million. And they were relatively pleased with the execution. So, and during the last 5 days prior to it being executed, they were getting feedback from the market that said that more and more people are interested in the product because of the yields. So our rates, literally in a week's time frame, came down 50 to almost 7/8. So they come down. Now, where are they going from here? I don't know that we're going to see rate changes here in the next 30 days from now, but I would suggest that most of us that came back into the space have shrunk down our products. It's real important that we're making loans that perform. And as we do those and we get through a next securitization period, 60, 90 days downstream, I would suggest if all of that works out, and if we don't have any blow-ups in the market, COVID returning or anything like that, I'd say that you're going to see the rates come down again. Not sure they're going to come back down into the mid-4s, which is where we were 90 days, but I think they'll come down somewhat from where we are. Sorry for the long answer.
It's okay. So I'm going to combine several questions into one, which is people want to know our max LTV, our minimum credit score, and the max loan amount.
Well, max LTV on Super Prime, which is the Alt-A product menu that we have, max LTV is 80, minimum FICO is 680. In the expanded area, which is what I call it our non-prime type of products, and in this bucket we put our non-owners that are bank statement or full doc. The highest FICO is 80%, and the FICO is as low as 640. Then an investor cash flow, which is the DSCR product, the LTV max is 70 and the lowest FICO is 680. And foreign national, the LTV is 65. We don't have a FICO there. Now, I make exceptions all the time, so let me just give you a couple of examples. Okay, investor cash flow. A guy comes in and he wants a loan, and he's got a 614 FICO, and my minimum FICO is 680. But he's putting 35% cash down, and the property cash flows nicely, and he's never had a mortgage problem in his life. I'll consider doing that loan because of the 35% cash down. I may ask him for another 5% cash down and do it at 60, but it's not a no, we won't do it. It will be a let's take a little deeper dive look. So same thing in the expanded area. Even though we say 640 is our minimum, when along comes that borrower that where the loan makes sense, so you got a lower LTV and the credit's really not that bad, it's not representative of the score that he's got, we'll consider it. We're make sense lenders. We've done it for, well, I won't tell you how old I am. Let's say I've done it for more than 20 years. And so we've always made loans that make sense. Now, if you're asking me for that 80% bill consolidation loan to the borrower with a 610 FICO, I would say to you, take that one to my competitor.
On the interest-only 40-year program, you said 10/1 interest only, then converts amortized over 30 years. So now the payment is principal and interest?
That is a true statement. That's ultimately how we get our money back. It's got to convert to a fully amortized loan at some point.
Okay. And with loan, how are we handling student loan deferments when calculating DTI?
I don't have the guidelines open, but pretty much I think our guidelines say that if they're deferred out a year plus, we're good to just not showing them as a debt. So
Okay.
the calculation is, the debts divided by the income, not including the deferred payments.
Okay, great. And let's do a couple of more questions. I see that a lot of these are very specific to specific loan programs, to specific scenarios. So please go ahead and email me those, and I will get those questions answered for you. I have a few questions asking about construction loans. And do we offer them?
A construction to perm loan, we do. We have a set of guidelines associated with it. We're going to look at what the borrower bought the property for, how much he bought it, when he bought it. We're going to want to verify that. We're going to want to source and season for that purchase down. Then we're going to, every deal is different thereafter. If the guy bought the land 6 years ago, I'm going to probably use the appraised value. If he bought it 5 months ago, I'm going to probably be really focused on what his spend was on the property. So they're unique deals, but we will consider them.
Do we do manufactured loans, manufactured home loans?
When we readdressed our guidelines, I think we might have taken them out of the guideline set. We've never been a big proponent of them. We used to have them in our guidelines, and every time one came by our desks, there were, I can say that we've done about a half a dozen of them. So I'm not sure of the guidelines. I don't want to misspeak.
Okay, we'll do one more question. Do you do loans under corporation name, specifically refi cash out?
Yes, we do. We will do it in the corporate name, and the LLC. We need personal guarantees when we do so.
All right, great. And with that, Joe and Jamie, do you have any closing statements?
I would just say we do appreciate the relationship we have with you. And we thank you for the business that you may have given us in the past, and we look forward to working with you in the future.
Thank you.
All right, great. Thank you so much for joining us. Bye-bye.